Hello, I'm Lelda Smits for the Finance News Network, and joining me from AMP Capital Investors is its Head of Investment Strategy and Chief Economist, Dr. Shane Oliver. Shane, welcome back to FNN.
Thank you, my pleasure.
At the beginning of the year, you told me the S&P ASX 200 index will climb up to about the 5,800 level by the end of the year. We're now sitting at around 5,500. Are we tracking better or worse than you expected?
I think by year end we'll still get there, but I'd have to admit the first 6 months have been a bit slower than I would have thought, and there's several reasons for that, but the two main reasons are the fall in the iron ore price below $100 a tonne and the impact on confidence from the sort of toughish federal budget in May. So those things have really taken a toll on the Australian share market, both in terms of the miners and retailing stocks. But by the year end, I still think we'll get to 5,800. The share market certainly doesn't look expensive, and I think that confidence will start to lift, particularly if the budget has to be softened to get it through the Senate. And we've still got an environment of very low interest rates, which looks like it's going to continue for some time to come. So therefore, the chase for yield, the search for higher returns will continue. A lot of that money will go to the share market.
Defying the doomsdayers, US and local shares have continued to rise. But are we vulnerable to a correction, and what's likely to be the catalyst?
Well, there's often a correction in markets around the middle of the year, and the old saying used to be, and it still is, sell in May, go away. So far we haven't seen the correction, but we are in the middle of the year and we're still in a vulnerable period. US shares have had reasonable gains year to date, and there's a few triggers out there. For example, Ukraine situation still unresolved. The situation in Iraq could threaten oil prices. We've got the risk at some point that the Federal Reserve will become more hawkish regarding the outlook for interest rates. So there's plenty of triggers out there for a potential correction. So at this stage, I certainly wouldn't rule one out. And over the last few years, we have seen corrections around the middle of the year.
Now, reporting season is almost upon us. What are some of the themes you've noted from confession season?
Obviously, a big negative has been the retailers. Lots of retailers downgrading. Particularly since May, that sort of period which was impacted by the budget. But if you strip them out, not too bad. The confession season hasn't been too bad. There hasn't been as many downgrades, profit warnings as I would have feared.
And Shane, what is your outlook for reporting season? What sectors are likely to fare well and which could come under some pressure?
My feeling is the reporting season will be okay. So we'll get results for the last financial year, 2013-14. They'll show profit growth in aggregate for the market of around 13%. So even if you are worried about the impact of the May budget on spending in the economy, don't forget that was right at the end of the financial year. That was in May, so it's impacted May and June, so only a couple of months. But the basic picture will be reasonably good profit growth, around 13%. The resources sector will be the bright shining light there. They had a tough year the previous financial year, profits went backwards. Now they've got their costs under control. The mining investment phase is winding down. They're starting to see their exports pick up. And of course, we've seen a lower average level for the Australian dollar over the last 12 months than we did over the previous 12 months. So that also helps in translating earnings. So resources shooting the lights out with 30% profit growth. Drilling down a bit further, financials will be doing pretty well. Low double-digit profit growth there. Banks seeing good return, good profit growth, around 10%. And then we sort of go down a bit further and we're looking at the industrials excluding the financials, and profit growth there will be somewhere of the order of 4 or 5%. The sort of range it's been in for a while now. I reckon retailers will probably struggle a little bit. At one end you might have media stocks, they'll be doing okay. I think profits there will be up something like 25%. But the industrials, manufacturers and so on, they'll probably see profit growth of minus 20%. So a bit of a range coming through outside of the resources and the financials where a lot of the profit growth will be.
And Shane, as we enter the new 2015 financial year, what will be some of the key factors to watch?
I think there's a few things that will play out over the next year. Firstly, the global economy, I think, will continue to grow and pick up pace. Monetary conditions globally, by and large, easy, but at various points in time there'll be debate about when the Fed will raise rates, and that will cause bouts of volatility, so it could give us occasional corrections in markets. But generally speaking, monetary conditions internationally pretty good. Chinese growth, I think, stabilising around the 7.5% mark. That'll give a bit of confidence to commodity markets. So commodity markets probably not going to surge, but they're not going to collapse either, as some people were fearing. They'll probably end up recovering a little bit of their recent losses. And then likewise in Australia, I think we'll see a pickup in confidence, partly on the back of continued very low interest rates, and that in turn should underpin ongoing faith that the Australian economy will sort of transition from mining investment-driven growth to more broad-based growth. So basically a reasonably good environment for share markets over the next 12 months.
Shane Oliver, thank you for the outlook for fiscal 2015.
My pleasure, thank you.